Hello students. Today topic for discussion is capital budgeting. Capital budgeting refers to the long-term planning for proposed capital outlay or expenditure for the purpose of maximizing return on investment. Generally, capital budgeting will be done for automation and replacement of asset, acquisition of new assets, that is fixed assets. It is mainly done for the fixed assets. Capital budgeting is mainly done for the fixed assets, land, building, and machinery, etc. Even it will be done for the research and development as well as expansion of the new project. So these are the cases under which capital budgeting will be done. So what are the main steps involved in capital budgeting? First, they have to identify the profitable investment proposal. So the firm has to identify what are the different proposals available in the hands of the management. Next step, they have to do screening and selection of the right proposal on the basis of various criteria. It may be cost as well as profitability mainly considered by the firm. The third step is the evaluation of measures of investment worth on the basis of profitability and uncertainty or risk. So this is the one of the important criteria for any firm. They have to identify whether that particular proposal is profitable for the firm and as well as how much risk associated with that particular proposal. That also they have to consider. Fourth step is establishing priorities. That is, uneconomical or unprofitable proposal may be rejected. So when the company is calculating the profitability aspect, they have to evaluate the proposal based on various techniques. So based on the evaluation criteria, if the firm found that particular proposal is unprofitable, so in that case, what the firm can do, they can reject it, simply the rejected without considering other aspects. Fifth step is final approval and preparation of the capital expenditure budget. So now we'll see again what are the steps involved in capital budgeting. First one, they have to identification of the profitable investment. Second is we have to select the right proposal. Third one is the evaluation of measures of the investment based on the profitability, uncertainty, and risk involved. Fourth one is establishing priorities. In that case, when they are establishing priorities, they may reject the unprofitable one. Next step is, that is, fifth one is what they have to do, final approval and preparation of the capital budget. Sixth one is implementation of the proposal. Seventh one, review the performance project. Final one is project identification and generation. So these are the steps generally the company will follow. This vary from company to company. Next, we'll move on to the methods of capital budgeting. Generally, there are two different methods followed by all the firms. One is a traditional method. Under traditional method, payback period, discounted payback period, and average rate of return method. In case of discounted cash flow method, we are following net present value method, profitability index method, internal rate of return method. In case of discounted cash flow method, we will consider the time value of the money. But as far as a traditional method is considered, the company will not consider the time value of the money. We'll see one by one. Payback period method. Payback period method is very simple method, easily everyone can understand. So here, what is the accept criteria is the project with shorter payback period is accepted. The formula is original investment divided by annual cash flow. We will see with the help of one problem, we can understand how payback period method is applied in evaluation of the project proposal. Here it is given two projects, project A and project B. Both the project have involved cost of 1 lakh. So the inflow is given differently. Here, first year you see in case of project A 50,000, second year 50,000, third year 1,10,000, fourth year nil. In case of project B, 1 lakh, second year 5,000, third year 5,000, fourth year nil. So totally, actually in case of project A, the payback total amount of inflow is 2,10,000. In case of project B, the total inflow is 1,10,000. So now we'll see the payback period here, how cumulative cash flow we have to consider. See, in this case, first year 50, we want to find out how within how many years we are able to get back our investment of 1 lakh. So here you see year 1 50,000, second year 50,000. So altogether within second year we are able to get back our investment of 1 lakh. Here in case of project B, we want to get back our investment of 1 lakh. We are able to get back the investment within first year. So in case of project B, project A, we are able to get back our investment for the period of 2 years. But as far as project A, B is concerned, within first year, we are able to get back our investment. So our conclusion is the project B is shortest payback period. So we can accept project B when compared to the project A. It has the payback period of 2 years. Second method is the average rate of return method. Average rate of return method, the formula is average income divided by average investment into 100. Even we can say that original, that is average income divided by original investment also. We have different formulas for computing ARR. Each formula will give different answers. So now in this case, we'll follow average income divided by average investment into 100. Average investment is equal to original investment divided by 2. That is the formula. Now we'll see this problem. The cost of the machine is 2 lakhs. That is the cash outflow of the firm. The net profit of the firm is given. First year 26,000, second year 30,000, third year 22,000, fourth year 38,000. In case of fifth year 34,000. As far as ARR is concerned, we have to find out the net profit. Net profit is nothing but profit after depreciation and tax. So this is the difference between cash flow and net profit. Cash flow, what we have to do, we have to calculate profit after depreciation and tax, but we have to add back depreciation in order to arrive cash flow. But as far as net profit is concerned, you have to directly calculate, deduct all the expenses from the income, including tax. So whatever surplus we got, that is called as a net profit. Here directly in this problem, directly it is given net profit. So the formula is average income divided by average investment into 100. Average investment is totally all the years income, we should add it. So 26,000 plus 30,000 plus 22,000 plus 38,000 plus 34,000. So all these incomes are related to 5 years. So total income divided by 5 years. We will be getting average income is 30,000. So what is our investment? Our investment, it's given that cost of the machine is our investment. So cost of machine is 2 lakhs. So what we should do in order to calculate the average investment, 2 lakhs divided by 2. So we are getting average investment of 1 lakh. Now you substitute in the formula average income divided by average investment. That is 30,000 divided by 1 lakh into 100. So we are getting the ARR, the rate of return is 30%. So this is about the ARR method. Now we'll move on to net present value method. So what is net present value method? This is the discounted cash flow technique. Here you will consider the time value of the money. What is the formula for net present value? So here present value of cash inflow minus present value of cash outflow. Here I will just write it. Present value of cash inflow value of cash inflow divided by cash inflow minus present value of cash outflow. Present value of cash outflow. So this is the formula. It is the difference between the total present value of future cash inflow and total present value of future cash outflow. This is the simple formula. What is the accept and reject criteria under net present value method? NP is greater than 0. That is, your present value inflow is greater than outflow. Definitely we can accept the proposal. It is a project. If the NPV now present value of cash inflow is lesser than present value of cash outflow, we have to reject the proposal. This is called as a net present value method. Here you should understand the present. In this case, what we will do, present value factor we will take. Present value interest factor is a formula used to estimate the current worth of the sum of the money that is to be received at some future date. So what is it? We want to consider the time value of the money. You take here example 1%. I just increased the screen size. Okay. Here you see a value of 1 rupee at the end of the when you calculate the 10%, see 1%, 0.990. Second year, the value has come to 0.980. So this is the formula they are using. You take the most here 10% you see they are discounting the value of the money. And at the end of the first year, the value of the money is 0.909. Your 1 rupee become 0.909. At the end of the second year, the value of 1 rupee become 0.826. Then third year, 0.751. So on, the value is given like this. So through this, we can find out what is its true value of the money. This table will be taken for calculating the present value of the money. So next is a profitability index method. It is also similar to the present value in net present value method. In case of net present value method, what will you do? Present value of cash inflow minus present value of cash outflow. But here, what will you do? Present value of future cash inflow divided by present value of future cash outflow. So I will explain with the example here. A project cost, that is the cash outflow. Cost is nothing but cash outflow. 4,50,000 and yield an annual cash flow of 1,50,000 for 10 years. Calculate the payback period. Here it's given payback period. Original investment divided by annual cash flow. So 4,50,000, 1,50,000. So this is the example for payback period method. This is for average rate of return. Average rate of, I will move on to the net present value method. Here it is given that Janaki Product Limited has 2 projects under consideration which are mutually exclusive. The cost of each of them is 1 lakh. So there are 2 projects. Each project have a cost of 1 lakh. Determine which project is better based on payback period, ARR, NPV, and present index method. Profitability index method. The discount rate is given 10%. We have already seen the discount rate, how they are doing it. Now we'll see the problem. Here, project A, it's given. This is the inflow is given. In case of project B, inflow is given. But what is the outflow for both the projects? See, here both the project outflow is the cost of the The cost of each of them is 1 lakh. Okay. So this is the cash outflow. Inflow is given here. Then directly the time value of the money is given for 10% cost of capital. First year 0.90, second year 0.826, third year 0.751, fourth year, so on, it's given like that. Now first we calculate here calculation of payback period. Payback period here, what is given? Cash inflows are not uniform. When the cash inflows are uniform, we can follow original investment divided by average cash inflow. That formula we can use it. But here cash inflows are not uniform. So you have to use cumulative cash flow. How many years it will take to get back our investment, till that time we have to add it. So here, what is our cash outflow of the project? So cash outflow is 1 lakh. Okay. Here you see cumulative cash flow. As far as project A is concerned, we are able to get back our investment 1 lakh. So we can stop here. As far as project A, we need not calculate 1 lakh 80, all these things. We can stop 1 lakh because payback period is 1 year for project A. You take for the example of project B, 20,000, it's given 20. Then 40 plus 20, 60,000. We are calculating the cumulative cash flow. Then 60 plus 60, 120. So we have to stop here. So how you should do it here? What you have to do? What is the formula for the payback period here? We are able to get back our investment in the second year. So if we move on to third year, our cash inflow is more than our cash outflow. So we have to stop within second year. Second year is second year plus how much is available. So for how much is required to make it 1 lakh, 60,000 only available. But how much amount is required to make it 60,000 into 1 lakh is 40,000 is required. But how much amount is available here? 60,000. So this is the formula. Again, I will repeat. This is within a second year, we are able to recover, that is 60,000. If you move on to third year, it will come to 1,20,000. So we have to stop second year itself. So second year, 2 years plus how much amount is required to make it 60,000 into 1 lakh, that is 40,000 is required. But how much amount is available here? Only 60,000 is available. So divided by 60. So our answer is 2 years plus 0.67. Payback period for project B is 2.67 years. So decision criteria is the project with the shortest payback period will be accepted. So we should accept project A. Next, the calculation of ARR method, accounting rate of return method. What is the formula we have seen? Average income divided by average investment. Average investment is not, average income means profit after tax, profit after depreciation and tax divided by average investment. Average investment is original investment divided by 2. So you take here average income. Here directly it's given average income. That is all the cases average income is given. 1 lakh plus 1,80,000, sorry, 1,80,000, 60,000, 40,000, 20,000 here, 20,000, 40,000, 60,000, 80. So what you have to do, directly you add up here. When you add up, divided by 5 years, because the project period is the incomes are given for the period of 5 years. So divided by 5, average income you are getting 60,000. Then average investment, original investment divided by 2. So we are getting average investment 50,000. Now you substitute in the formula average investment, that is a average income divided by, this is the formula, average income divided by average investment into 100. Now you substitute in the formula, you will be getting 120%. Here I want to share one more information. Suppose depreciation and tax, any data is given regarding income here directly given in the question. What they have given the question, cash flow is given, that is profit is given, nothing, no information regarding depreciation and taxation is given. Suppose it is given profit before depreciation, then you have to deduct the depreciation and tax, all the procedures you have to follow. But here no information is given, so directly you can take this is a profit after depreciation and tax, we have to assume like that. So we have calculated based on that. Okay, so here ARR for project is 120%. Similarly, you have to calculate for project B also 120%. So both the projects are giving 120%. Next, the calculation of the NPV method. NPV method, here cash flow is given, net present value is given, that is a discounting factor is given. PV means present value factor. Present value factor means you are converting the cash flow into present value. So for that you are discounting the money. 0.909, here it is given that all the values are given, directly multiply the second column into third column, that is 1 lakh into 0.909, you will be getting 90,900. Likewise, you multiply all the values. When you multiply all the values, you will be getting total present value is 2,41,780. So less our cash outflow is 1 lakh is given. So our inflow is, that is here you see inflow is more than outflow. We can accept this proposal because accept or reject criteria is the value more than 0 will be accepted. So 1,41,780 is a surplus money we are getting out of this. So the project A can also be accepted. Now we'll see the project B. Similarly, how we have done for project A, same steps we have to repeat. Here also 20,000, 40,000, all the values are given. Here 0.909826, this is the discounting factor, that is present value factor at 10%. It's given. Multiply, here you are getting 2,13,020 minus cash outflow. Out of this you are getting here surplus is nothing but net present value 1,13,020. Here 1,13,020, but you see the project A 1,41,000. Here you see 1,41,780. So we have to accept project A. Project A gives more NPV than project B. So now calculation of present profitability index method. PI means profitability index method. Here same principle we have to follow. Only thing is here the formula is present value of future cash inflow divided by present value of future cash outflow. So that is the procedure. So we are getting 2.41. Here, what is the accept and reject criteria? The project which has more than one can be accepted. Now we'll see the project B. What is the value? We'll see. In case of project B, 2.13 we are getting. Here you see 2.13 we are getting. But in case of project A, 2.41. So your net present value also supported the project A. Here profitability index method also supported project A. So decision is project A should be accepted because of higher and profitability index method. Now another sum we'll see. One more problem we'll see what is the payback period, how we are calculating here. Here one problem is given. Each of the following project requires cash outflow of 10,000, sorry, 1 lakh. Each, so, okay, 10,000. You are required to suggest which project should be accepted if the standard payback period is 5 years. See, here you have to cash outflow is 10,000. That is the original investment is 10,000. 3 project cash inflow is given 2,000, but the cash inflow in case of project A, you see all the cash inflows are uniform. So we can directly calculate annual average income, that is the cash flow divided by original investment. The other 2 cases you see the cash inflows are not uniform. So we have to calculate the cumulative cash flow. But here also they have done. We have to 10,000, that is when we reach 10,000, we have to stop. In case of project A, the payback period is C 2,500. 2,500 to 5,000, they have calculated the cumulative cash flow. In case of project A, here, that is a project A. What is it? This is the payback period. That is 4th year is the project payback period. Now we see the project Y. First year 4,000. Second year 4 plus 3, 7,000. 7 plus 2, 9,000. 9,000 plus 1,000, 10,000. So in this case also 4th year we can accept. Then project Z on it. Project Z actually here 1,000 plus 2,000, 3,000, 3,000 plus 3,000, 6,000, 6,000 plus 4,000, 10,000. So now all the cases 4 years. This is the 4 years. So I think we can conclude what is payback period. Payback period is the shortest, the project which gives the shortest return. We should accept. There are 2 methods we can calculate when the cash inflows are uniform, when the cash inflows are not uniform. Not uniform means what you have to do, we have to calculate the cumulative cash flow. Based on that, we have to find out what is the accept and reject criteria. The project which has a shortest payback period will be accepted. The project with the longest payback period will be rejected. Then second method is the average rate of return method. Here the formula is average income divided by original investment or average investment. That is a formula. Profit after tax, after depreciation and tax will be considered. Next, the net present value. Net present value method is present value of cash inflow minus present value of cash outflow. Here we have considered the time value of the money. In case of profitability index method, just it is similar to net present value method. Present value of cash inflow divided by present value of cash outflow. So these are the things, main aspects of capital